of the EU oil embargoes kicks into place. This time it is on oil products coming out of Russia. And we take stock 1 month into the year with Brent crude oil more or less where we started, dipping below $80 a barrel at the close on Friday, with WTI in the low 70s. So certainly a kind of an interesting picture. Let's start off with Mike Muller, head of Vitol Asia. Mike, a month into this year, after a lot of things in January, can you identify, is there clarity yet, or how do you see the first month?
When you say clarity, relating to how Russian products can continue to flow under the
let's
various
get
measures?
to that. No, I mean, I'd
Right.
say more clarity in a broader sense at the direction of travel of the market. I mean, we've been started 80, nearly went up to 90, we went back to 80 again. It looks like a slightly confused January. My question is, do we now have some clarity of direction?
Yes, I think the various forces that should determine flat price will be the resumption of demand from China, which we talk about every time we get together here. Whether or not the latest set of measures relating to Russia from the EU, the US, and the UK will impact output, exports from Russia in any way, or their arrival to market, which is a different thing. And of course, then there's the balancing mechanisms in the market also. This week elapsed is probably the week when there was least airtime on an OPEC Plus meeting, sort of been relegated in people's minds to maybe third spot in that equation. And then, of course, overriding all that is the concerns about global slowdown and the strong desire amongst OECD economies to keep the cost of raw materials in check, given that we've probably been able to label 2022 as a cost of living crisis. And then the final and fifth factor, I guess, is the weather, which has led to major relief on the natural gas and therefore utilities bill cost front in Europe, and taken that pressure off, which 2 or 3 months ago we would have all said would have been the number one preoccupation of markets and politicians.
Christoph Ruhl, Senior Research Scholar at the Center on Global Energy Policy, Columbia University. Christoph, welcome back, and welcome back to UAE. Christoph, the general narrative of January seemed to be euphoric financial markets on the back of the conquering of inflation and peaking interest rates. And then we finished the month, or just finished last week, with a bumper jobs report in the United States. Over 500,000 jobs added in the month of January, when it was forecast to be 175,000. That's a pretty scary indicator as to inflation hasn't gone anywhere. Your thoughts, is there clarity in that macro monetary policy making now, or are we confused?
Good morning. I think this is possible to have no clarity and not be confused at the same time. Let me help you with that one. So we do have, I think, no clarity on where inflation is actually going, with people divided pretty much 50-50 whether it has peaked or not. But it is clear that in both scenarios, interest rates are far from coming down. So the only question is, how much do they catch up to inflation levels further? And secondly, it is true what we have been here saying for a while, which is that the actual economy, all this recession talk aside, is performing much better than the word recession, the connotation recession implies. And that when we talk about recession, it's the technical terms. Even if, it's just negative growth for 2 quarters, it doesn't need to mean long queues of unemployed people. Right? And we're clearly in this world where we also not only had this job report in the US, but very importantly, I think at the beginning of the week, the numbers from the European Union indicating that they will not go into a recession, not even the shallow recession, which was discussed so very often. So the economy is still on a pretty stable footing. There's still a lot of money slushing around. There's still a lot of pent-up demand from the paychecks people have received over the COVID period and from the inability to go and travel and shopping in the COVID period. And we're still seeing this playing itself out. To the extent that one of the earliest warner of the inflationary dangers in the US, Larry Summers, now says, let's pause. Let's just, take the foot off the accelerator. Let's keep it steady and let's just wait a few weeks to see what the data actually is saying. So that's uncertainty about the future, but it's no unclarity. The question is long-term, will inflation be coming back to 2%, or will the Western countries have to settle at 3, 4, 5% because of the high debt levels? I believe the latter. Central banks pretend the former, so we will see. And one other thing I think important in connection with oil markets and energy markets, there's also uncertainty, but not unclarity. I think what we are learning is a very important lesson. You shall not look at oil prices constantly only against the mirror image of what interest rates and what the broader markets are doing. Oil markets, to some extent, in the short term, oil prices are driven by expectations about growth in China, things like that. But overlaying it time and again is the fundamentals of oil markets themselves. And there we had, this ride up at the beginning of the month with everybody again talking how oil prices would be exploding. And then the fact that there was just an excess, no noticeable excess demand and prices moderating. And I wanted to, at this point, ask something to you and to Mike, which I'm not quite sure I understand. If we come to the embargo for products, and you tell me when the right point is on that.
Yeah.
But I think overall the answer is the economy is doing well, and we don't know where it's going, but every little bit is explainable what we have seen.
Mike, just sort of starting on that sort of embargo question, I wanted to start at it through China. 2 months into the China abandoning its zero COVID policy, are we any clearer as to the momentum of economic recovery? Because in a lot of ways that could determine whether the embargo on Russian products creates a shortage or not. Because as long as the Chinese are exporting lots of products, the market seems well supplied. But if the Chinese economy gets going again and starts restricting its exports because it starts consuming more of its products, then we could have a shortage. How do you see those dots connecting?
Yes, you've touched on some really important pieces of the jigsaw here for 2023. Yes, we do have the data now for the Chinese Great Migration, as they call the Chinese New Year, which was so much earlier than in previous New Years that you need to normalize the data. But January was a bit of a funny month because of the slow start in the Western Hemisphere with New Year, and then the big Chinese New Year holiday from the 22nd, which basically the last day of the Chinese New Year fortnight is today. So that migration showed some rather interesting things. The government's forecast numbers in the first year in 3 years that the government had not urged the population to refrain from traveling to see their loved ones in their hometowns, saw public transport utilization somewhat fall short of the predictions from the government, but private vehicle voyages are way up above 2019. And that's partly a fact of the growing middle class in China and having more cars at their disposal, but it's also a sign that people still prefer to be in their own private transportation space than on public transport. The toll that letting the virus run in China was expected to take is obviously going to be very difficult to fathom. But I think the death toll and the hospital shortage concerns people had have not eventuated, as many Western commentators would have predicted in December. And that's certainly good news for China. And now for February, we have the first full month of normality where we have to see how things bear out. But there is a pretty upbeat feeling about China. And you can only point to certain pieces of evidence. China has the capacity, both in refining and certainly in petrochemicals, to run a lot harder. And if you look at the behavior of the major Chinese protagonists, they certainly accelerated their purchasing, which is a trend that started in December of crude oil, which is the start of that chain that then feeds the refining, transportation fuels and petrochemical side of the equation. And I think that has given the market quite a lot of confidence that China intends to run hard and to have the availability of products to cover the eventuality you predict there, Sean, that they might need more domestically than they thought.
Christoph, given the sort of pull on the products, the demand side, on the supply side, do you envisage that there will be a lot of disruption to Russian products? I mean, the Europeans seem to have sort of stored everything they could, even in their bathtubs, diesel, and to ensure that there won't be a shortage. How do you see this playing out?
I mean, first of all, if there's an embargo, from a large part of the world against something like oil products, then the other part of the world, like China, will get more of it, not less. So then there shouldn't be a problem there. But secondly, this is my question precisely. The way I understand the system in Russia is that they are hugely, of course, dependent also on product exports, big diesel exporter, all of that, big refining capacities, but very, very limited storage capacities for product storage. So a trade disruption, as it is inevitable now with the product embargo from the EU, should put pressure on crude prices. It may increase product prices, but it should put pressure on crude prices because Russia will export more crude and will try to get that into Chinese and Indian and whatever other refineries, if this is true, that their storage capacity for products is limited. I think that is what we have seen. I think that the prices this week came down was sort of the growing realization, or obviously that there is no shortage of crude at all, and that whatever is floating around in the market and not being sold in Europe and trying to knock on the doors in Asia has actually increased crude oil, not product oil, for reasons of this looming embargo from the EU. If that is true, then we may see sort of refining margins going up. That should be expected, and crude oil prices remaining under pressure, not taking the 90 or 100 hurdle anytime soon. And that would be pretty much counter to what most market observers continue to say. I'm getting tired of Goldman and the $120, $150 oil is nowhere in sight. But I wonder whether and I think that is the correct interpretation at the moment. That will then, of course, also imply relatively high refining margins, selected distortions in the product market with, lots of room for traders to arbitrage between them and make some money. And I think that will put the refining system, the global system, again, to a little bit of a test, how quickly they can adapt. And in my entire experience, since I watched energy markets, I've always been surprised only in one direction, which is how flexible the global refining system actually is. And so from that perspective, I wouldn't be too worried that the increase in refining margins will be lasting either.
Pick up on that, Mike, your thoughts, because the added part of that puzzle is also the fact that the big US refineries going into maintenance, having sort of delayed that given the bumper profits to be had last year. So with the refining maintenance season coming and this situation in Russia, that's a lot more crude that isn't being turned into products. And so, yeah, maybe that is a reason to see Brent dip below 80. Your thoughts on that?
Yes, tricky there, Sean. I mean, I think it is a fair observation that refining margins were such last year that any maintenance that was discretionary could be pushed back into 2023 was pushed back. So therefore, the preponderance of the refining system to have unscheduled hiccups and problems is greater, as many of these refineries are 50, 60, 70 years old. And that is a concern. At the same time, of course, we have to look at the behaviors around the Russian deadline. I mean, February 5th today was a date that incentivized people to take as much Russian into the European system as possible before that was no longer acceptable. And I think looking at the behavior of Russian refiners, the margin is such that if they can export maximum products, I think they will. Of course, they have to make a calculation every time there's a negotiation that they're able to have as to how big the discount is on crude and how big the discount is on the refined product in the new world that we've now been served up as of yesterday. But overall, refiner margins are astonishingly good still and looking relatively resilient. I mean, it's been a long time since I've seen gasoline cracks as strong as this in January, February. And for distillate to be holding in the 30s and at times in the 40s above Brent dollars per barrel is a pretty special, pretty proud level as well. So it doesn't reflect recessionary fears or fears of some sort of demand implosion. It reflects a world where some are expecting close to 2 million barrels a day year-on-year demand growth for refined products, with diesel leading the way, and the overhang of very great concerns that maybe the world will not be seeing quite as much Russian, and maybe the very large diesel exports that have been coming from China have also some downside if the Chinese demand accelerates. And then the last thing we have to bear in mind is, as Christoph already indicated, if the world is going to have to realign and redirect its refined products that come out of Russia from the Baltic and the Black Sea all the way to Asia, that's a much, much longer voyage. So you see a phenomenal stock build on the water, which accounts for or takes away the best part of a whole month's worth of exports. And that's another form of demand. And then if you overlay on top of that the potential headaches that maybe the market can't absorb all the Russian under the new February 5th directives that we've only just seen as of yesterday. I think in most companies, the legal and compliance divisions are still plowing through the small print. It is possible to envisage that there'll be even more stock build on the water as people park that oil on ships awaiting news whether or not.
Is that, Mike, why we're seeing this massive growth in what's called the shadow fleet of tankers? Trafigura, one of your peer group, has said it's up to 600 ships now in this sort of shadow dark fleet that is outside of the sort of oversight of regulation.
Yes, I saw the article that you sent us in the pre-read, Sean. I mean, it is definitely a number in the hundreds. I don't have the exact figure that was quoted in that particular interview, but
600.
You have, I think the numbers that were given are roughly 2/3 of that are crude, and it's a very substantial part of the global crude fleet. And 200 or 1/3 of those would be products, which is still less significant portion of the global clean product fleet. But yes, the point I was trying to make is if that fleet is not hurrying from A to B, but prevaricating and waiting around to see what rules permit people to bring oil to market, with insurance and banking systems able to pave the way for that oil to actually be discharged with a customer, presumably in Asia, then that fleet may serve as an on-the-water parking spot, awaiting further clarity on what people can and can't do.
Go ahead, Christoph.
This is not some surprising development or something sinister. This is a Russian program which has been pre-announced and has been building up for a long time. Remember that just to address the crude embargo and make it toothless, the price cap, you would need many more ships than they actually have under control. And so they continue building it up and paying expensively for it. And that will continue independently of when the product embargo kicks in. And how it affects the situation. What the point I was asking is, what we are seeing putting upward pressure on refining margins because of all this market distortions and trade redirections, and downward pressure on crude prices. And I think that is what we're seeing, and I don't see that really addressed systematically in the trade press. And it has to do also with the lack of storage capacity in Russia.
Well, let's just pick up on that point, Mike. I mean, with the reflection on January, when Brent and WTI behind it tried to make its way up to the 90, while all of the financial markets were on a tear into the new year on Chinese optimism and so forth. But crude just didn't seem to have the legs. It started out the year, as we said earlier, where it is now. What's not in the demand cycle, do you think, that is giving oil the lift to where the financial markets in general seem to see the future?
I'm not too sure. I mean, I gave you 5 factors at the very beginning of this chat, and I think, yes, the move up from low 80s to high 80s was probably most supported by continued reassurance and confidence in Chinese demand for energy. And we've now seen some indices that give you a view that the recessionary fears are on the wane. Good productivity data from China also, by the way, on top of the jobs data from the US. So honest answer is I don't know. The market.
I suppose you could get a situation on the vulnerability of the oil demand picture is that one headline that guides China's back and the other indicates, no, it's going to be another few months. That can have a big sway in the momentum.
John, isn't it pretty clear that the answer lies exactly what I tried to say earlier? This looking at macroeconomists' forecasts doesn't get you very far in oil markets. It explains day-to-day movements, maybe. Everybody gets gung-ho about China or bad about interest rates. But at the end of the day, you have to look at causes shifting real oil demand and supply. And we find them if we look there. No? There is no shortage. And that's why oil prices sort of tickered up and then fell
And
down.
I do think
that's the lesson for this year so far.
The macroeconomic outlook is, despite the sort of enthusiasm in the financial markets, the risk on equities, Bitcoin, and so forth, there's still fractures in the global macroeconomic outlook. Yes, the IMF has revised upwards some slither of economic growth, but you still have data points like the biggest number of highest percent of car defaults in the US, debt payments on car loans in the US since the great credit crash of 2007-8. Last year, you had 30% of a single family home dwellings in the US transactions down by a third. There are indicators that there's some real fractures emerging, as we're still very much in the early days of 5% interest rates, and its trickle down could be sizable on demand, hence the softness.
Yes, but what I'm saying is a much more simple point. The staring at macro indicators and, as an energy analyst, only listen to what these guys are saying will not get you very far in predicting where energy prices are going. And Mike gave us a good list of other reasons, and you just mentioned some of the things we have to look at. I think that is the reason of the first months. There can be uncertainty and clarity in what indicators to look for. And it's not just whether China performs or not. It's not just expectations, in other words.
Yeah. Let's get the survey question, just the thought on where we'll post this on social. Will today's EU ban on seaborne imports of Russian refined petroleum products cause a shortage in the market? We had the Saudi energy minister over the weekend saying that these continued sanctions would cause a shortage in the market. And we've yet to see that in crude. Will we see it in products? Mike, looking forward, the reflection on the month past to the month ahead, as you said, the first full month of the China kind of reopening post Lunar New Year, clarity. We saw Asia as a whole looking quite positive on crude demand in January. Your outlook for the month ahead for that sort of momentum to build towards China and Asian demand?
Yes, I mean, it feels better than it did a short while ago. Just back to your price point, I mean, $80 is not a bad price for OPEC Plus, right? It's obviously, in some people's opinion, at the lower end of their preferred range, because we've seen rhetoric and even action whenever prices have dipped to this level or into the 70s indeed. But I think it's a price that works for most in a world that still has some elements of fragility to it. So, I mean, what do I say going forward? You've already mentioned refining turnarounds, but the major thing people are grappling with is now how these two new price caps that have been put forward by the UK, the EU, and a note from Janet Yellen, namely $45 a barrel for prices that trade products that trade below crude, and $100 a barrel for products that trade above crude. That's as specific as it was. How that actually gets translates itself into real action. Now, you mentioned crude. Crude is 2 months ahead of us because we had the $60 price cap for crude, which was roughly $20 below the crude market at the time, or $15 below where Urals was trading with relatively fewer impositions at the time. And we've seen how that panned out. As Christoph said earlier, most of that crude found its way to market with open arms in places like India and other countries, major economies in Asia. Whether that's the case for products as well, I've already mentioned that I think there will be an on-the-water stock build to the extent that uncertainty remains over what aspects of the supply chain are going to feel the pinch. And I need to emphasize this: the sanctions will not be on the buyer necessarily or on the seller. They will also impact in a big way the shipper, the ship owner, and also the insurance provider. And we've said this on numerous occasions in the past. The P&I clubs are largely bodies that are registered in G7 countries, many of them in the UK, if you remember, entities like Lloyd's of London, and then the various P&I agencies that spin off there, like Britannia. So these are the IG, as they call it, the international group, are the de facto providers of maritime insurance. The market now needs to scrape around for insurance providers that are not from G7. Right, and the same goes for shipping. One of the responses of the market has been what you described as the fleet, seeing a portion of its fleet devoted to doing Russian trade. And then finally, there's the banking channels. We mustn't underestimate. There is a hesitancy I detect amongst Asian banks here in Singapore, certainly, right now until there's further clarity from their legal advisors as to what the ramifications are if they start paying ultimately supplies of Russian when new rules have been introduced by the G7 forbidding certain transactions. And we haven't yet mentioned the efficacy of the cap. I mean, if the price cap is observed, then G7 providers can be utilized. So it's fine to use a Greek ship and to use a British insurance company and to use a Singaporean bank, absolutely no problem. But we just don't know, because you need an attestation from the original supplier that that cargo was indeed sold at below $45 a barrel if it's something like fuel, or less than $100 a barrel if it's diesel. And we know that fuel is trading, depending on what quality of fuel, between $60 and $70 a barrel, and diesel is currently at more like 120. So many, many questions that the industry is going to have to address over the coming weeks. And whether or not His Excellency, the Minister of Saudi Arabia, is going to be proven right in suggesting this might result in less oil on the market remains to be seen.
Well, it'll be interesting to see if the market reacts to his comments tomorrow morning. Christoph, looking to the month ahead, of course, there is this thing called a very big war in Europe with supposedly 500,000 Russian soldiers stacking up, German tanks coming in. The outlook of the geopolitical crisis there, we had over the weekend the Chinese, I think, vice premier or some senior official coming back from Russia saying we're best buddies still. Your thoughts on where that plays into the outlook equation?
Let me tie it to your previous question, because they're, of course, related. I don't think that the product embargo per se will cause any new features. If anything, products are easier to pass around and to smuggle. If anything, the markets has got more used to combining banks and insurances and ships from different countries. So I think on that front, the short-term forecast would be that we see an increase, which we're already seeing, a pretty massive increase of Russian product exports into friendly countries such as the one we are sitting in right now, and an increase of Middle Eastern exports from refined products into Europe, miraculously, very quickly, and things like that of that nature, just as we saw in a crude passing into Asia, and a parallel building up of the shipping fleet. But this kind of resilience and this kind of adjustment will continue as long as the cap isn't too far away from market prices. The further it gets away, the more pressure will be put on the system. So what we might for short-term forecast is they stay in the current vicinity, not much of an impact except the temporary increase in refining margins we have been discussing. Secondly, and now comes the connection to the theater in the Ukraine, everybody is now talking about, not everybody, most people are now expecting a Russian nature offensive, trying to come ahead of the expected Ukrainian offensive and before the weapons are on the ground. So as the war there heats up and as the oil caps remain in place, the looming danger on the horizon really is that it gives Russia the ability to manipulate crude prices. The product thing is just more or less a footnote to that. The Russian administration has the ability to scale up and down the kind of Russian crude which reaches the market. And as long as they don't have a major breakdown with OPEC Plus or fallout from OPEC Plus, that I think is what they will do. If Russia comes under really severe military pressure, if economic pressure continues to build up as it does at the moment, then somebody like the Russian president has shown that he's willing to do this before in the European gas markets, will start, and this is not binary, he will not start cutting off oil and everything goes to hell in a handbasket. No, he will use it, in order to keep oil prices up and to put pressure on the Western economies and to derail this nascent recovery, on continuing recovery, which we see then. That's the rational thing to do. And the price caps give them, so to speak, a trigger, which is now much more elegant, much more targeted, much smoother than before when it was just a crude, to export less or more. So now you can, with much less leverage, you have much more leverage in a market which has so complicated outlets where oil has to be shipped for much longer than before, so that any kind of action on that front translates into a bigger impact on the ground. And I think, I don't know where the Saudi energy minister came from, but I think that statement that we will run short of oil, be it refined or not refined, so might materialize if Russia decides to do so. They are having the trigger at the moment, and there's very little capacity, and there remains very little capacity in the system whether it's in strategic reserves and the ability to act quickly and so to react to that. So it would isolate the US some more and would put pressure on Europe. And that's almost, if Russia is almost a trade-off. The more Russia loses out militarily, the more likely that becomes.
Yeah, that's going to be an interesting window of time on this sort of end of winter, spring offensive in that war. When losing is not an option for either side, where does escalation stop? Mike, last word to you to just follow through on that comment by Christoph on the price cap structure. We saw a story, we had it in the digest today, Indian refiners paying traders in dirhams for Russian oil coming out of the UAE. Is that a notable development? Your thoughts on that, sort of moving away from the dollar piece?
Dirham is tied to the dollar.
I know, but yeah, it's still settled in dirham. But it's, yes, it is pegged.
Short answer, Sean, I don't think it's anything new. I think that's been happening for some time. And it's not new that Emirati and Middle Eastern banks have been able to act as conduits for those flows. Okay, well, let's just close it with that and the survey result. Will today's seaborne imports of Russian fine products cause a shortage of the market? No, from our group today. We'll post that on social and see where it goes. But as always, we're going to miss you, Mike, in London at IPIE week. It's not the same if you're not there. I'm not quite sure. We'll have to find different remedies. But have a great month, Mike. Really, thank you for joining us today. And Christoph Ruhl, as always, thank you very much. Perhaps we'll catch up while you're in town. All the best. Bye. Thank you.
Thank you.
Bye-bye.